morning, students. Today we shall study about the part 2 of money and banking chapter. In the previous part, that is in part 1, we have discussed about the topic money. But today in part 2 we shall discuss about the topic banking. And under banking topic we are going to discuss about that what are the functions of the central bank and how central bank controls credit in our economy. So let us now proceed further with the functions of the central bank. As we already know that Central Bank of India is also known as Reserve Bank of India. It is the apex bank. It means that all the other commercial banks work under or as per the indications given by the central bank, because it is the apex bank and it lies above all other commercial banks. So while discussing about the functions of the central bank, the first function of the central bank is bank of note issue. Note issue is the sole authority function of only central bank. It means that commercial banks have no authority regarding the issuing of the notes. But previously also, that is in part 1, it has been told to you all that ₹1 note as well as coins are being issued by Government of India or by Finance Ministry. But the rest other currencies and coins or currency notes and coins are being issued by central bank. So in this way, the sole authority of note issue lies with the central bank. The next important function of the central bank is banker to the government. Yes, the central bank is a banker to the government, agent to the government, and an advisor to the government. As a banker to the government, what happens? The central bank accepts the deposits of the government, and as an agent, it buys and sells securities on behalf of the government. And while acting as an advisor to the government, it helps in framing various types of policies that are related to the money market. So in this way, the central bank acts as a banker to the government. Now the next important function of the central bank is bankers bank and supervisory role. Bankers bank, just as the commercial banks, that is SBI, PNB and all other banks are the banks of the general public, in the same way the central bank is banker to the all other commercial banks. It means that just as commercial bank accept deposits of the general public and grants loan at the time of the need, in the same way the central bank also accepts the deposits of the other commercial banks or commercial banks and at the time of need grants loan to those commercial banks. It also acts as a supervisory role. It means that it supervises the rest other functions of the bank, just as it gives indications regarding the CRR, SLR, that what it is to be maintained. Next is lender of the last resort. Lender of the last resort function of the central bank arises when people start losing faith in the bank. And then after that, what happens? When people start losing faith in the banks, they start withdrawing their money from the bank. And banks have no such historical experience that today this much customers are going to come, because by experience or by some historical experience they can only guess that this much customers are going to come. But when the public starts losing faith, then at once on a single day a huge customers start coming and withdrawing their money. At that time, what happens? The banks suffer lack of funds, and at that time the central bank acts as a lender of the last resort to the commercial banks. Next is custodian of the foreign exchange. Foreign exchange means foreign currency. So the foreign exchange reserves lies with the RBI. In addition, it also manages the managed floating. Managed floating is the involvement in the rate of exchange in order to maintain the international rate of exchange between our home currency and with rest of the other currencies. So in this way, it acts as a custodian of a foreign exchange. Next is clearinghouse function. Now let us understand this clearinghouse function with the help of one example. Suppose that there are two banks, Bank A and Bank B. Both are having their deposits with the central bank. Now what happens? Bank A receives a check of 10,000 rupees drawn on Bank B. And on the other hand, Bank B receives a check of 20,000 drawn on Bank A. Now what happens? The clearing of checks does not involve any cash transfers or does not involve any cash. Actually, both the accounts or clearing of check is handled through credit entries in the bank accounts, because both the banks are having their accounts with the RBI. So in this way, central bank acts as a clearinghouse function for the two banks. Next is control of credit. Control of credit arises when there is problem of inflation or deflation in the economy. When there is inflation in the economy, then there is need of decreasing the money supply from the economy, and when there is problem of deflation in the economy, then there arises the need of increasing the money supply in the economy. And this function of the central bank is performed with the help of some instruments known as quantitative instruments and qualitative instruments. So now let us proceed further that how Central Bank of India controls the credit with the help of these quantitative and qualitative instruments. And also let us know that what are these or what are the various types of quantitative and qualitative instruments. The first quantitative instrument is bank rate. Bank rate is that rate at which RBI or the central bank gives loan to other commercial banks for long term. So what happens when the bank rate increases? Automatically what will happen? The supply of money from the economy will decrease, and when bank rate decreases, the supply of money in the economy will increase. So if there is problem of inflation in the economy, so what will happen? The central bank will increase the bank rate, and when there is problem of deflation in the economy, then the central bank is going to decrease the bank rate. Next quantitative instrument is open market operations. Open market operations means that buying and selling of securities on behalf of the government. Now when what happens when the central bank sells the securities? Then it means that its main motive is to decrease the money supply from the economy. And decreasing of the money supply from the economy means that there is problem of inflation in the economy. So as a result, what will happen? In order to decrease the money supply, what is happening? The central bank is selling government securities. And on the other hand, when there is problem of deflation, what will happen? The central bank is going to purchase those government securities. Next is repo rate. Repo rate is also known as repurchase rate. See, there is a similarity between the bank rate and a repo rate. The similarity is that It is also a rate of interest at which RBI gives loan to the commercial bank, and it is also a rate of interest at which RBI gives loan to the commercial banks. But the only difference between the two is that it is a long-term lending rate and it is a short-term lending rate. In this, there is involvement of securities, and in this there is no involvement of securities. So at the time of inflation, again what will happen, there is need of decreasing the money supply, and when there is need of decreasing the money supply, the repo rate would be increased, and when there would be need of increasing the money supply, the repo rate would be decreased. Now comes reverse repo rate. Reverse repo rate is just opposite of repo rate. Since repo rate is the rate of interest at which commercial banks get loan from RBI, and reverse repo rate is the rate of interest at which they means commercial banks park their surplus funds with the RBI. So it is that rate of interest. Again what happens? During inflation, the reverse repo rate would be increased, and during deflation, the reverse repo rate would be decreased. Now comes cash reserve ratio. Now this cash reserve ratio, in short, it is also known as CRR. Commercial banks are required to keep a certain percentage of their total deposits with RBI, and the rate is known as cash reserve ratio. And what happens when this cash reserve ratio increases, then the credit creation power of the commercial banks decreases. As a result, the money supply in the economy would decrease. On the other hand, if this CRR is decreased, then the money supply in the economy would increase. Again, another quantitative instrument is statutory liquidity ratio. In short, we call it as SLR. The total assets or commercial banks are required to maintain a certain percentage of their total assets in the form of liquid form, in the form of gold, cash or unencumbered securities. So as a result, when this SLR increases, the money supply in the economy decreases, and when this SLR decreases, the money supply in the economy increases. Now let us proceed on the qualitative instruments. First one is margin requirement. Margin requirement is the difference between the amount of the loan and the collateral on which the loan is being granted. The more the difference between the two, what happens? People don't reach or people don't demand for loans from the commercial banks, and when they don't, and when they will not demand for the loans from the commercial banks, automatically what will happen? The supply from the economy, money supply from the economy is going to decrease. So when there is problem of inflation in the economy, the margin requirement is increased. And how margin requirement is increased? Margin requirement is increased only by increasing the amount of the collateral. Next is ratioing of the credit. What happens during inflation? There is need of decreasing the money supply from the economy. As a result, Reserve Bank of India issues some guidelines regarding the quotas that is to be fixed, regarding the credit that is to be given different sectors of the economy on the priority basis. The sectors which are on priority basis can easily get credit from the commercial banks, but the sectors which are not of so much utmost importance lag behind regarding the credit availability. But when there is situation of deflation in the economy, then there is need of decreasing the money, increasing the money supply in the economy, and as a result this rationing of credit is withdrawn. Next is moral suasion. Actually what happens, firstly RBI or Reserve Bank of India issues some guidelines to the commercial banks to follow its directives. But if the commercial banks don't follow its directives, then that means the central bank puts pressure on the other commercial banks to follow its directives. Thus, we can say that moral suasion is a combination of persuasion plus pressure. And so, in this way, we have discussed about functions of the central bank and how central bank controls the credit in the economy with the help of some quantitative and qualitative instrument. Now in next part, that is in part 3, we shall discuss about the credit creation function of the commercial banks. Thank you.